Welcome back, everyone. Today on the Joseph Carlson Show, we get into the month of July, and we're already off to a great start. Stocks are in the green across the board. Things are looking great. Even though today was a short day in the market, we have many companies moving up to all-time highs. And historically, this is typically what it's like. July is a great month. We're going to be going over some of the data here, explaining why investors do so well in July. We also have some good news today. People are still being employed. There's still hiring going on, jobs opening. And this is a narrative that has a lot of debate. We have a lot of CEOs now just publicly saying that AI will wipe out a lot of jobs. We have Salesforce saying that AI is doing 50% of their work now. We have the CEO of Ford predicting that AI will replace literally half of white-collar workers. We have a recent episode I did just on Amazon going over how robots will be delivering packages in the future. And so we have this narrative of both good jobs reports and AI replacing workers. How will this pan out in the future? We'll be looking at that. Now, as a lot of people talk about the finish of the tech run or when this bull run will eventually end, we have Dan Ives saying that we're just getting started. We'll be looking at his remarks. Tesla's vehicle delivery numbers are in a decline for the second quarter in a row. You'd think that's a bad thing, but not everybody agrees. We'll be looking at some responses here. We also have Robinhood's new product in Europe where they're tokenizing different private companies where you can buy a derivative of a company like OpenAI. Now, this is only in Europe, but this has already made some waves. OpenAI doesn't seem to like this new tool from Robinhood. They've come out publicly against it, warning investors about it. We'll be looking at what this actually is, what Robinhood is doing here, and why OpenAI doesn't like it. So we have a lot to get to in this episode. To start things off, we just jump into today. Looking at the market today, we have another big green day in a short amount of time. And this is, of course, going into the early 4th of July weekend. It makes sense that people are excited. We have a bit of a break. People get a break from work. Lots of people going on vacation, lots of shopping, just a lot of activity. People are usually happier in July. And that's part of the reason why I think the market does well. I think a lot of this is based on psychology. If we look at some of the companies here, we have a lot of momentum in this market. Microsoft is right on the verge of $500 per share. I remember making videos about Microsoft just a couple years ago around a price of $220 per share, saying that it's a buy, it's in a huge dip, it's a great company. And look at this activity. It's gone from $220 now to $500, over doubled since then. We have other ones like NVIDIA pushing up past that $140 mark. It's been stuck there for quite some time, but now it's up to $160. So lots of momentum in NVIDIA. We have Intuit up 2% today, now getting close to $800 per share. This is one a lot of people said it was overvalued or they have a lot of stock-based comp. Intuit's proving a lot of people wrong. They're spending less with fewer employees while growing revenue even faster. Part of that is due to their implementation of AI. We have companies like Amazon, which have now gotten back above that $200 mark, now up to $222. I think that Amazon, even though it's up another 1.36% today, I think you're going to see more and more of this momentum. We have Google, which has some of the worst sentiment, some of the worst trading going on with it. It's one of the few companies that's really big and powerful and profitable that's being left behind in the rally. But even today, it moved up a little bit, up to 180. So we're getting up to the point where we're almost getting back to the green with Google. Not much, but this stock is still starting to move in the right direction. I think we're going to see more of this as well. Then we have Uber. Uber's now up to $90, $93, $94 a share, up another 1.81% today. Investors in Uber are not scared about the robotaxis. They're not scared about Waymo. They are on board with the Uber thesis that this company will consolidate. It'll become a very useful platform. That Uber's just too big. The network effects are too strong. And the company's at a great valuation. In my portfolio, it's reached all-time highs, now well above $900,000. When I look at some companies, I'll just highlight a couple here. One of them is in the consumer category, a company that people thought was in a lot of trouble because travel would slow down. That company's Booking Holdings. Even with the tariffs, even with all the uncertainties that went on a couple months ago, Booking Holdings is doing incredible. We have their upcoming report, and I think it's going to be very good. All the TSA numbers, the airlines, all of those are completely packed. They're doing next to record numbers. Doesn't matter what's going on. People like getting out and traveling. It's just incredible to see what's going on with the portfolios, with the market, and I'm sure that yours are doing great as well. And I think in times like this, when the market is bullish, even if you want to be level-headed, and you don't want to get too excited when the market goes up. You want to stick to your investing philosophy. I still think it's good to just be happy about it. Celebrate the wins. We have a great stock market. We're making money right now. As investors, you take on additional risk investing in companies. That is the risk premium. And the payoff for that is when the market is doing well like it is today, like it is this year. Investors that took on the risks, that made investments, should feel good right now. You should be very happy. You put your money in work in companies. You took on additional risk. You didn't just sit it in a savings account, and now you're making gains. And even though I think, again, it's good to stick to your investing philosophy, it's good to be disciplined, it's not good to have FOMO and to chase into whatever stock is going up the most, I think there's a difference between that and just being happy with the performance of your portfolio, that the strategy is working, that the risk premium that you took buying these stocks is paying off. We're seeing a lot of that happen, and I think it's worthy to celebrate. So the first thing I'd mention as a thing to do today is just to celebrate what's going on. The second is I think we can learn a couple lessons. One of them is to not get scared out of your investing strategy when stocks go down. And I know it's much easier said than done, but a lot of people entering into this year were very bullish, but then they turned very negative when the tariff thing happened. As soon as Trump came out, April 2nd, he had his tariff board. He gave the ridiculous reciprocal tariff rates. The math didn't really make sense. There's a whole, that whole event that now looks a little bit less important, looking back in history, it felt very real at the time. And it scared even great investors out of their positions. I talked with many investors that are great investors. They pick the right companies, really good companies, ones that are up 30, 40, 50% this year, but they got scared after that event. They said that this is different than historical events. This is the US not partnering with anyone. They're becoming secluded. The huge taxes on everyone. And it shook a lot of people out of those positions. Some people moved from their individual stocks into ETFs. They got more defensive, got more conservative with their positions. And I think that that's the wrong approach. When investors start getting scared, when the market really starts going down, that is the time to strike. So if you stayed invested during those time periods, you should pat yourself on the back. Now, if you're one of the investors that was able to put aside the common sentiment, the prevailing sentiment of the time during April, you kept to your investing philosophy. You put more money in the market than you otherwise would have. You maybe took some out of savings to buy some companies at a deeper discount. I think that's worthy of extra celebration. You've proven to yourself that you can invest. You can do it really well. Picking companies is important, but controlling your investing philosophy, controlling your psychology, your temperament is even more important. So if you're able to do that, congratulations to each of you. Now, there's something interesting that happens in July. Based on the data here, we already are off to a great start. And historically, July is almost always a green month of the year. Now, there's a lot of ideas of why this is, a lot of common thoughts. One of them is just psychology of investors. July is a nice summer month, lots of travel, lots of spending. But overall, we don't really know the reason why. What we do know is just the data. July is almost always a green month in the market. In fact, the last red month, the red month overall in July, was back in 2014. So it's been a decade of green Julys. So we don't know if it's going to happen this time. I think it's more than likely going to happen, looking at the momentum this market has, but we're off to a good start. Another positive catalyst, I believe, this month is the jobs report for last month. We had steady hiring, adding 147,000 people to the 1,000 employees to the job market. So we added 140,000 jobs. The economists, the polling, the consensus was that we were going to add 110,000. That's a pretty sizable beat. And even with AI, with ChatGPT, with Gemini, with all of this efficiency, with the way that we're automating things, the unemployment rate continues to fall. So that's good news overall. The one caveat here is that a lot of these jobs were concentrated in state and local governments, they say particularly in education. So not all of these are private sector jobs. But if we look at this year over year, this is this month, and then we have the other prior months. It looks like we're gaining jobs at a steady pace, and the US economy is still doing great. Now, there's an argument here that anytime job growth is really strong, it means that Jay Powell, the Fed chair, is less likely to lower interest rates. So a lot of people will argue that a good jobs report is actually bad for the stock market because it means interest rates won't lower as much. This is a lot more simple than people make it out to be. Simply put, a good economy is good for the stock market. There may be some fluctuation, it may not follow one-to-one, but over time, the better the economy, the better the stock market. The reason why is that the people that are buying at Amazon, the people paying for Netflix, the people doing all of this need to be employed. They need to have jobs, they need to be gainfully employed in order to buy the products that our companies in the stock market sell. So simply put, a good economy is good for the stock market in the long term every single time. Now, on that note, we're getting this contrasting view. We have both of these news items right next to each other. One of them is that the unemployment rate came down. There's more people finding work now than ever. The other one is that AI is wiping out every job, and it's going to wipe out further jobs in the future. These are two very contrasting views. We have this article here from the Wall Street Journal saying that CEOs start saying the quiet part out loud. AI will wipe out jobs. This is the Ford CEO. He says, quote, "Artificial intelligence is going to replace literally half of all white-collar workers in the US." We also just recently did an episode on Amazon where I went over my case of Amazon being the best robotics play. Part of that thesis is that Amazon is uniquely positioned to benefit dramatically and disproportionately from the advent of advanced robotics, humanoid robotics. Andy Jassy has also said pretty openly that there's going to be a lot of humans that are replaced by robots and artificial intelligence. You can reference other people that have spoke on this topic as well. The Anthropic CEO has been very outspoken in saying that this technology, artificial intelligence, is going to cause huge job loss. This theme of CEOs saying that artificial intelligence is replacing jobs is getting more and more present. We have the CEO of Salesforce here, Mark Benioff, saying that AI is doing up to 50% of the work at Salesforce. Now, I've had the same take on this for a long time. I agree mostly with what these CEOs are saying, which is the whole idea that AI is incredible and it's going to automate a ton of jobs, a ton of the type of work that we routinely do. And while investors look at this and you invest in companies like Amazon or Salesforce on the basis that they're going to become more efficient, that they'll have a lower employee expense, they'll have higher margins, which is in the short term really good for investors, it brings up the question, the natural question that arises from this, which is what happens to all these employees that are being laid off, that are being automated away? What do they do? And this is where my opinion diverges from that of the CEO of Ford or Anthropic, warning about massive unemployment and that half the workforce is going to be wiped out. If we look at history, anytime we've had a revolutionary technology that automates many of the processes that we've done previously or are doing now, it's true that we can understand the jobs that are being replaced, but we don't know the new opportunities this will create. There's so many things that AI, artificial intelligence, robotics, allows humans to do that they could have never done before. So many new opportunities. The CEO of Google, Sundar Pichai, I believe summarized this best. He said that the company Google came out far after the internet was invented. Yet it's one of the biggest companies in the world, one of the biggest internet companies in the world. The company that exists purely based on AI likely hasn't even started yet. And it will start at some point and become one of the biggest companies in the world, employing hundreds of thousands of people. So this is the type of opportunity that awaits. Right now, we understand the short-term impact artificial intelligence may have on employment. What we don't understand is how many new opportunities for work this could create in the future. So I'm not quite on board with this thought process that artificial intelligence and robotics will erase all opportunity, that we have a very bleak future to go into with no jobs available. And so far, even with last month's report, the most recent data, we don't see it in the data yet. Now moving on, we get to this interview with Dan Ives where he talks about the tech bull run that we're in. We know that tech companies have recovered dramatically from the lows of 2022. People are throwing out many of these great companies. Now they're moving up to higher and higher valuations. Dan Ives is asked about where we are in the tech bull market, if it's getting towards the top or like a tipping point. Here's his reply.
This is just starting. I think it's a 3-year tech bull market still ahead of us. As all, what I view as AI, $2 trillion of spend in the next 3 years.
He thinks that we have a 3+ year bull market in tech ahead of us with the advent of AI pushing stocks higher. And that makes sense. I'm very bullish on the tech companies that I have. I think they have years of growth ahead of them. But he's also asked about valuation. We know again that many of these stocks are pushing to higher and higher valuation territories. They're no longer in the low 20s or in the teens. Now they're up into the high 20s, sometimes well into the 30 PE ratio. They're trading on a lot higher multiples of future earnings than they were just a couple years ago.
This is the biggest tech trend we've seen in the last 40, 50 years. And I always focus, if you just focus on valuations, you missed every transformational tech stock the last 20 years. I think you have to look at the next 3-5 years what growth looks like. And I think, to me, tech is actually undervalued relative to where I see this. And that's why I think a lot of the bears, when they're in hibernation in those caves, they can't see AI in the spreadsheets. I think that's why we're so bullish, especially across not just software, cybersecurity, and across the rest of the ecosystem.
Now, it might be easy to criticize this point of view, look at it as a bit flippant to just ignore valuations, but I don't think that that's what Dan Ives is saying, and I tend to agree with his point here yet again. I think every investor has been guilty of this. In fact, it's really easy to just look at the forward PE ratio and base your buys off of that. You see a company that's at a cheap forward PE ratio, it looks very tempting as an investor to want to pull the trigger and just buy that company. And in many cases, if you sacrifice quality in doing so, if you lower your standards of the quality, the moat, the future growth potential, the profitability, how ingrained the company is in society, how bright the future is, if you forget about all of that and you just start focusing on the PE ratio, you'll get poor returns in the process. Companies are not worth just what they're worth next year, what their earnings are going to be 1 year out. We're investing in companies as owners of the business. We're entitled to the profits of our equity ownership from now until Judgment Day, for the entire lifespan of a company, 10, 20, 30, 40, 50 years out. We have a stake in the profit for that entire time period, 30 plus years. So just looking at the forward PE ratio is obviously not the best strategy. Now, while again that's true, I also think that this can be taken to the wrong extent. There's investors that focus a little too much on the future and completely ignore all valuation metrics or all reasonable valuations. We have Tesla, which we know this company trades with a lot of future expectations. So Tesla investors are buying this company. They have share in it based on a robo-taxi network that they believe will be quickly scaling, profitable, and dominant. The other narrative going on with Tesla is the Optimus robot. If they can sell a lot of those, that's another big growth path for the company. So this stock naturally trades at a very high valuation. We're at a valuation of 130 PE ratio. And again, this doesn't say everything for the company. We need to look at the circumstances. One of them is the amount of Model 3 and Ys being delivered and the other models. So basically, the combination of these two stacked bar charts is all of Tesla's vehicles being delivered. This was down 14% year over year. Tesla's core business of vehicles being delivered is in decline, and it's been in decline for 2 consecutive quarters. If we smooth this out on a quarterly trailing basis, I think this gives you a clear picture. It's been on a steady overall decline since around Q4 of 2023. It started to work its way back up a little bit until 3 quarters ago. Now it's on a more steady decline going down further. Now, I understand that investors in Tesla are not so concerned about the amount of vehicles being delivered, but this should be something that raises some eyebrows. The core business of Tesla is struggling right now. If I contrast that with one company, and again, I think this is so simple to do because we have Google here, which is also a tech company. It also has a dominant share. It's in a lot of great businesses, but it trades with far less expectations of the future at a 19 forward PE. If we look at Google and even their troubled business, even the disrupted business that ChatGPT is devouring, it's just crushing their core business, that is the search business. If we look at the search business alone, it grew 10% year over year last quarter. More people are using Google's search. They're doing more searches. They're more engaged in this product than they've ever done before. And they're adding in a bunch of different ways to search, multimodal ways. You have Google Lens, you have Gemini built into different phones and different applications. The other parts of Google we're not even concerned about. So I compare and contrast these two opportunities because I think one of them is just far less risk than the other. We'll have to see, but my money right now is still in Google. Now, if we look at some other news here, this is an interesting story. OpenAI is upset at Robinhood because of a new product that Robinhood is starting to sell that gives investors indirect access to investing in OpenAI. Now, if you're not aware, OpenAI is a private company. Investors like you and me, we're not in the inside group. We don't have access to buy shares of this incredible company. We can kind of indirectly buy some of it if we invest in Microsoft, but it's a small proportion. It's not the same as the really special investors, the really big ones, the ones like Mark Andreessen or Peter Thiel, the billionaires that get special access to investing in companies like OpenAI. Well, Robinhood is trying to democratize investing. They're trying to give access to investors like you and me to be able to invest in a company that's private like OpenAI and make it so it's not just the elites, the billionaires that get access to these incredible companies. Well, what's the way that Robinhood has decided to do this? Well, Robinhood acquired shares of OpenAI through something called a special purpose vehicle. This is something where they have access to buy equity in companies like SpaceX or OpenAI. Private companies that only something like Robinhood, that's an institution that can get in the in-house, they're in the inside club, they get access to these shares. That's the special purpose vehicle. So they have the actual shares of OpenAI. But then Robinhood made a tokenization, a token that gives investors access to a claim over the price tracking of their special purpose vehicle. So they have the shares of it, and then they're selling a token that tracks the price of the shares that they have. It's a bit like playing telephone with the shares. You have a company investing in OpenAI, they hold the shares, and then they create a token to track the share price. Now, the important thing here is these tokens do not give you ownership over the shares that Robinhood holds. So if you buy a token of OpenAI on Robinhood, you are not buying shares of the shares that Robinhood owns. You're not buying part of that special purpose vehicle because they can't do that. They're not legally able to pass along that equity. But Robinhood found a loophole. They can allow users to indirectly invest in OpenAI by simply tracking the price of the shares that they hold. So even though you don't have an ownership of the actual shares of OpenAI, you are tracking the price. It is an indirect investment. It's like a synthetic investment. It's a little bit like using DraftKings to bet on a sports team. You don't have ownership of anything, but you still get the reward for whatever outcome you're predicting. If OpenAI becomes more valuable, investors in these tokens in Robinhood should fall along proportionate to the gains that OpenAI makes. So even if you don't own direct equity, you're still getting a relatable outcome. So Robinhood made this product, they launched it, and it looks like OpenAI is not happy about this. They're not happy that retail investors have found a way through Robinhood to get access to the outcome of OpenAI, a private company. They tweeted out yesterday, these OpenAI tokens, in quotes, are not OpenAI equity. We did not partner with Robinhood. We're not involved in this and do not endorse it. Any transfer of OpenAI equity requires our approval. We did not approve any transfer. Please be careful. So there you have this very dismissive, almost condemnation from OpenAI. It's very clear that they're not happy about what Robinhood's doing. And I think their response here, their condemnation of this tool really underpins one of the problems going on in the market. And that is that there are massive, enormous companies, ones like OpenAI that have hundreds of millions of users, generating billions in revenue. They have equity valuations privately that exceed $300 billion, yet they remain private. They don't let anyone from the public access equity in these great companies that rely on the US market, that rely on us, the consumer, to use them in order for them to make their money. But when it comes to investing in them, they have somehow shielded themselves from having any access from the public. The only people that are privileged enough to be able to invest in them are the likes of Mark Andreessen, Peter Thiel. You have investors like Brad Gerstner. You have people that have the access and the know-how to get into these special privileged situations. They have access to these awesome assets that nobody else has access to. To me, that doesn't seem fundamentally fair, that a class of investor has special access to these great companies, relying on the rest of the US economy to grow, and they refuse to go public. They just go year after year after year, growing ever and ever bigger without ever giving any access to public investors. And then when we find a way, when Robinhood somehow finds a way to give investors a synthetic level of access, not even clear-cut access, no even real ownership, but just to track the outcome, the price of it, they're upset. They're furious at it. They're furious that you and me, that investors, found a way to be able to track the price of it. So this is something that I've thought is a problem for a long time. I see it with other companies as well. You have companies like Stripe, one of the biggest payment processors in the world, the rails for so many transactions done online. So many SaaS companies use them. It is a massive company, and it's private, and it just remains private all the time. It doesn't feel right to have a company that's so big in society, relies on so many customers, but nobody's able to benefit from the actual growth and equity of the company. In the markets, it's healthy to have companies go public. It's healthy for the economy. It's good for people to be able to benefit and grow alongside a company, to have your wealth tied to the success of the products that you love and use. So if you love ChatGPT, if you use lots of products online that are using Stripe, if you're wanting these type of companies to go public so you can share in the success, I'm in favor of this. I'm happy that Robinhood's doing this. And if anything, even if I don't buy any of these tokens myself, I'm probably unlikely to buy them just because of the third-party nature of it. But even so, I'm happy that Robinhood is doing this because I believe it will put some pressure on these companies to rethink their stance on remaining private, even though they're worth excesses of $100 billion. They should rethink that stance, and I believe many of them would benefit from being public companies. And the markets would probably benefit from the additional regulatory oversight from being a publicly traded company. So I'm glad that Robinhood's doing this. I'm glad that they're putting pressure on these companies that if they try to blockade public investors from accessing any type of gains from their company, that we're going to find a way to do it anyways. That's going to be it for this episode. Hope you enjoyed. See you in the next one.